This is InvestTalk. Independent thinking, shared success.
Hi, it's Andrew from Buffalo. I was just going to take on RedCat, ticker RCAT, stock in the drone space, and just interested to hear what you guys think about it. Thanks.
All right, looking at RedCat, and they provide software as a service that markets, designs, and develops solutions for the drone industry. Now, this is a company that was growing nicely, although last quarter revenues were down 61%. That's not good. Not loving that. No dividend. Earnings are still negative, but they're getting better. Earnings last year were negative 33 cents. This year, earnings are supposed to be negative 19 cents. And then next year, it's supposed to only lose 2 cents. So clearly, the analysts are getting excited about the path towards profitability. And I certainly like that. And then the question is, though, this stock has moved already. Let me pull up a chart here. And it's moved from a low, let's see, back in last summer around $1. Now we're at $9.43. $755 million market cap. You're talking about revenues of only $16 million. Still negative free cash flow, although that is improving, except for last quarter, it got worse. So I don't like that. Initially, right here, you have this big move, and their cash burn went up, decided to go up a little bit last quarter. Still getting better, but over the medium term. But in the short term, it's getting a bit worse. They're issuing more shares after this move as well, diluting shareholders. So, to me, it's just still crazy expensive. You're talking about price to sales of 40 times. That's egregious. And so I think you missed the move. I think you want to keep on your watch list, monitor it for improvements in cash flow and profitability, see what other competitors there are out there. This is a good time to say, okay, just because this happens a lot where investors jump on a name because it's the only public company that you can gain exposure to something in an emerging kind of space, like drones in this case. I almost guarantee you they're competitors to RedCat. What are they? Probably a lot of them are private. Is RedCat even in the top 3 in the ones that are used the most in the strength of their technology? Those are the things that I would be doing right now, figuring that out. Are they truly the leader? Or are there others as well? Do a competitive analysis there. So interesting name to have on the watch list, but I wouldn't be buying it here, mainly because of that valuation. It's just too egregious. Thanks for the call. Now let's go take one of our questions submitted via our YouTube channel. And Jimmy G says, he's from Sweden. He says, I own ALSN. I wonder if you know if something special happened today as writing the stock is down 15%. They had an earnings report yesterday, but that looked totally fine. Was that expectations that much higher? Then it still dropped 15%, or am I missing something? I've checked the company's balance sheet and profitability and so on. It looks very good. What do you think? Or is this maybe an overreaction or something to look out for regarding the company? Good question. This is ALSN. This is Allison Transmissions. This is a name we've owned for a while. When did we buy this? Pull separate. Yeah, we bought it back, I want to say maybe in the 30s, 40s, somewhere in there. Now it's at 101. It did have a reaction to earnings that was negative. Simple as that. But it just pulled back to the 200-day moving average, so it was kind of overbought. And yeah, the earnings report, as you said, was fine. Even the estimates for full year 2025 were smack dab in the middle of consensus. So not high, not low. They're right in the middle. Last quarter, revenues were up 3%, earnings were up 5%. Once again, that was pretty much in line. And those are nearly $10.50 next year on a $100 stock. It's about 10 times earnings. With clean balance sheet, great business, great profitability. We still own it. In fact, we picked up some for new clients around 96 yesterday. Now it's at 101. So already up nicely there. I'm already seeing a bounce here off the 200-day moving average. So Yeah, you're right. You're not missing anything. Sometimes these things happen. Stocks go on big runs, and there's a lot of optimism already built into the price, and all that has to happen is the market or the report doesn't have to come in great. It comes in okay, and you get a pullback in the market, or in the stock, but you have to look at the broader trend here of both earnings and the price. Both are going up over the long term. Good business, good cash flow, and I don't see anything changing in the short to medium term. So, good buying opportunity on this pullback for ALSN.
Thank you for tuning in.
If you enjoyed this content, please give us a thumbs up and subscribe for more updates.
Hello, InvestTalk. I was calling in with a question regarding tips and was wondering, would this be a good time to get into this as a hedge against inflation? So wanted to get your thoughts on that, and I will be listening to your podcast. Thank you.
It is. I think it is a good time to get into Treasury inflation protected securities. If that's now, there are different ways to get hedges against inflation. Now, tips are one of them. You can just go by TIP, which is the iShares tips bond ETF, or STIP. That's probably my favorite. That's the short term, kind of 0 to 5 years, so you don't have the duration risk there. So that's the way I would go if you're trying to pick up tips and have that part of a broad portfolio. I think of it as the bond slice that hedges you against inflation, because typically bonds are terrible hedge against inflation unless you have something like tips. And so if you have bonds in your portfolio, you have a relatively low risk tolerance, but you still want hedge against inflation, tips are great. Now, are they the best hedge against inflation? No. I mean, equities do better. If inflation goes up, then you will get with tips, but it's riskier, right? And, there's more downside if you go into a deflationary environment, right? Equities tend to fall. And so it's a more volatile bet on inflation. Whereas tips, you don't have the downside when you hit some sort of recession or deflationary bust, but you still get that inflation hedge during those inflationary times. Thanks for the call. Now let's move back to a question submitted via the comment section over on our YouTube channel. And Marco Mike says, Train TT has had a decent pullback. Wondering if this would be a good time to establish a position. It's a solid company with good fundamentals. Assuming the pullback is related to the DeepSeek news, hoping to identify an entry price. All right, let's go look at TT. This is Train, and this is a company that manufactures climate control units and products that increase industrial productivity and efficiency. So the simple answer here is, the pullback was triggered by the DeepSeek news and the idea that, maybe there won't be as strong of a build out for these data centers as there were before, because the compute power to build AI models or run AI models is not as high as everyone expected it to be. And so you see names like Vertiv as well as Train here taking a step back. Now, what I will say is that it's near support around $350 per share. It's at $361 after this recent bounce. So it bounced off that $350 level, but that's no longer support. As long as it kind of chops in this range, it could easily break below. And if you go look at the fundamentals here, it's pretty expensive. Okay. And growth has already slowed a bit. You're talking about earnings growth was 20% last quarter versus a year ago was at 38%. So that's already slowed. Earnings this year is supposed to be at 14% and 12% next year. So you're talking about a low teens growth rate in an environment where everyone and their mother was deploying money towards AI infrastructure. I think that is going to shift to a degree. And there's probably going to be a continued slowing of demand here. And I think this recent downtrend from a high 422 or 361, it's already down 14% off its high. I think it could easily go much, much lower. Now, what would the support level be? Well, ultimately, the best support level would be around 205. But 235, that's also a pretty good support level. So until it gets there, sub 250, that 235 range, I would not buy it yet. Because I think the multiples need to come down. You're talking about a forward-looking multiple around 30 times earnings. Just too high for my blood. So I'm passing on Train, but continue to keep it on your watch list because, like you said, good company, just too expensive after this recent run and just starting its downtrend. Let's talk a little bit about foreign stocks. Foreign stocks. I don't know if you know this, but the German DAX up more than 9% this year in dollar terms. And the France's CAC 40 up about 8%. The S&P only up about 2.5%, 3% on the year. And so the European indices are starting to outperform for the first time since 2015. Okay? Up until this time this year, in the year. It's the first time since 2015. Think about that. A decade. Then you have other foreign countries, like even China's doing pretty well this year. And this is out after everyone has kind of left foreign stocks for dead. It's all about, U.S. dominance. And usually when, I want to say there was an Economist article recently or a Barron's article talking about the strength of the United States and our markets. And history says when you get those magazine headlines, the peak in sentiment is very close. And so the question is this, it's a short move, right? It's only 6 weeks, but it's noticeable. You're talking about double and triple the performance in just a handful of weeks compared to our markets. Now, the Eurozone ended 2024 with zero economic growth in the fourth quarter. And you already talked about tariffs on Europe. But you're starting to see the expectations for European growth accelerate. And that's on back of the valuations here. The S&P 500 trades at 22 times projected earnings over the next 12 months. In Europe, it's 14 for the Stoxx European 600. And it's 12 for UK stocks, United Kingdom. They're nearly half the multiple. Now, certainly there's a growth trajectory here for our companies that's much better, but is it worth double? Our value, should valuations be double? Growth has to be drastically higher for an extended period of time for that multiple to make sense. And profit growth in Europe is picking up. The Stoxx Europe 600 earnings per share growth expected to be 7.7% this year. Last year was only up 2.6%. So you're seeing earnings expectations accelerate. And what you have realized is a lot of these European countries, they actually sell into the United States. So is the sentiment around tariffs and Trump, has that been priced in? And is the market fading that and not believing that Trump is for real? That's a potential here. And then there's expectations that central banks in Europe will cut rates more aggressively because their inflation picture is not as bad as ours. Our inflation has leveled out and looking to head higher. And then on the political front, you have the geopolitical uncertainty in Europe starting to potentially abate. It looks like Russia and Ukraine are probably going to come to the table at some point in the next 6 months and come to some resolution. And France's government this week, they survived a no confidence vote, which means that there's no crisis ahead for France as a whole. And then in Germany, you're having new elections. So hope is springing eternal. And then you have, what was the other one? There's another one. Anyway, the point here is that what's happening around the world is sentiment has gotten too extreme to the negative side. And all you need is a little bit of improvement, a little bit of healing, restructuring, adjusting, and you can get a big move in those names that are trading at very, very low valuation. So I think this is potentially the start of a move. And so if you want to up your foreign exposure in your portfolio, this might be a good time to do it. Now we've got time, so let's drop in another listener question that came in earlier from Atlanta.
Good evening, guys. This is Chris from Atlanta. I wanted to see what your thoughts were on starting to dollar cost average into Pepsi. I see it's trading in near a 52-week low. When you look at a chart, it's kind of trading where it was back in 2020. I know that it's forecast to have low growth over the next year, but as a dividend king, figured maybe you could start investing now over the next year and collecting the dividends while waiting for it to hit another growth spurt. I'm interested in seeing what your thoughts are on this. Thank you, guys. Have a good day.
All right, looking at Pepsi. Now, the first thing I would say is I kind of like that you're looking for a larger name that's a bit down in its luck and trying to find good values that, long-term profitable companies have similar profitability over time. Can ebb and flow, but it reverts to a mean, shall we say. And right now, Pepsi has been struggling. Its 52-week high is $183 per share. Now we're down to $144, down 21%, which for a large cap name with $200 billion market cap like Pepsi, that's a pretty big pullback. This is your typical bellwether blue chip stock. And nice 3.75% dividend right now. But earnings are slowing. And they look like they could be headed towards negative territory. This year, earnings are only supposed to be up 2%. 2. And right now, its P ratio is about 18. So a little bit less than the broader market. Remember, the broader market is heavily weighted towards those bigger Mag 7 names that have better growth rates. So am I going to pay 18 times for something that has low single digit, if not headed towards flat earnings growth? Probably not. Then you add on the fact that you have RFK, just got confirmed as HHS secretary. Obviously, he is very skeptical of the big ag and the food industry and likely to impose things like forcing the soda companies to not put high fructose corn syrup in their sodas and use cane sugar, things like that. And then, Pepsi, it's not just about their drinks, but also their snacks. And, he's talked a lot about seed oils and, fixing our processed food problem, and does, think of all the chips that are supplied to schools that are at, sandwich shops. Is there pressure from the new administration to get rid of that? Supply schools with healthier whole foods. And I think there's a big risk to these junk food companies over the next 4 years. And so, if Pepsi was trading at rock bottom prices, I might say this is all priced in. Too pessimistic. People are still going to eat bad food to a degree, and you can't legislate that out of existence. And I think that's true. But I need a cheap price. I need a bargain basement price. And while it's getting cheaper, it's not cheap. Okay, and they have a good amount of debt on the balance sheet. $7 billion in free cash flow on a $232 billion enterprise value. What's that? A 3% free cash flow yield? No, I need a 8% free cash flow yield. So, and then if you look at the cash dividend pay ratio, it's 100%. Means every cent of their free cash flow is being paid out to dividend holders. I don't like that. I don't like that. It means that in order to continue that dividend, they're going to have to borrow more money or improve their business, which is currently headed downward, or cut their dividend. So I would not be buying this. Keep on your watch list for time when everybody hates it and there's a huge spike in volume and nobody wants to own Pepsi. That's when you pick it up, but not right now. Let's make it 2 in a row from 888.99 chart.
Hi, I love the show. Wanted to get your take today on Brinker International, ticker EAT, and what your thoughts are in the restaurant industry in general in this economy. Thank you very much. Have a good day.
All right, let's take a look at Brinker. Wow, this is a name that's had quite the run here. From just a year ago or beginning of last year was around 38. Now we're at 160. I do not understand this. This has had a recent pullback. Okay, 16% in just the last week or so. It's trading in the mid-20s in earnings. Oh God, I would not be owning this. Now, for everyone else out there, Brinker owns Chili's, Maggiano's, I believe. Yeah, Chili's, Maggiano's. What else? I thought they were Olive Garden as well. I could be thinking of another one. But yeah, basically Chili's and Maggiano's, and earnings just skyrocketed. But I just don't see anything structurally different about this business. This is way too expensive. The cost of running a restaurant is very, very high now. You missed it. Actually, this is a good short, to be honest with you.
Learn more about our services and insights by visiting InvestTalk.com.
Let's go take a live call. James from New York asking about his 401k.
Yeah, I often hear you say that an employer has a fiduciary duty to its employers to provide an adequate, best possible plan. Mm-hmm. If I'm a member of a union of tens of thousands of people, and just say there is one person who finds that the plan is not adequate or to their liking and that it can be better, is that sufficient to make a change in the case of an individual? Is that a possibility?
Well, that one person could sue, right? And there's legal costs around that. It'd probably be more of a group of, a group of employees suing and finding reason for that. Once again, I'm not a lawyer in that sense, but yeah, I mean, they do have a fiduciary duty, so somebody could sue the employer for breach of their fiduciary duty. And usually this is around, providing a plan if it's, too high in fees, doesn't provide the adequate investment options for you, and it's not just fees around the investments. It could be fees on how to maintain the cost of maintaining the plan and being passed on to you as well. So, you probably don't want to sue just one person. You probably want to put pressure on management and point out, here are the problems with our plan. These costs are too high, or we don't have these investment options, or we don't have the ability to do X, Y, and Z. And then you can put pressure on them to, and remind them that they do have a fiduciary duty to listen to you and make changes that are necessary.
Okay, thank you much.
No problem. Thanks for the call. Now let's talk a little bit about the Trump trades. And quietly, since the beginning of the year, the Trump trade is actually reversing in some ways. The strong dollar post-election is now down on the year. Bond yields that were much higher pretty much since late September through the end of the year are starting to fall. And what's happening here is the market's kind of reassessing what is real in this Trump administration when it comes to economic policy, meaning what is just an empty threat, what is a bargaining chip, and what is actually likely to come to fruition. Just look at, you have the 25% tariffs on Mexico and Canada that were paused for 30 days. And he got not much out of really not much out of it from pushing that back 30 days. So how real is he? But then you have China, 10% tariffs. That was real. That's been implemented. There's been reciprocal tariffs. China adding some on our goods. So the tariffs have not been as aggressive as many have feared, and that caused the dollar to fall. And then you have Doge, looking to cut spending. I've said this before, while wringing out excess and waste from the government, it's probably something everybody can get behind. The simple fact that government might be spending less is actually bearish for the economy in the short term. That's reality. That's just how math works. And that's why the dollar or the 10-year rates have fallen a bit as well. Worries that if they get too crazy, too quick in cutting spending, that could spark a recession. So things like bets against the euro, Chinese renminbi, they're not rewarding investors this year. The dollar gained 8% from late September until the end of the year. And asset managers flipped net long for the first time since 2017 on the dollar. But this year, the US dollar is down about 0.5% against major currencies. The 10-year peaked at 4.8% in early January. Now it's at about 4.5%. And so there's worries that, what everybody was pricing into markets and economies, that you get these tariffs that would strengthen the dollar, you would get a stimulus package like tax cuts that would help the economy. As I said before, it's all about order of operation. And so far, the order of operation has not been very bullish for the broader economy, at least in the short term. But as we know with Trump, anything could change. Well, that about does it. I'm Justin Klein. This completes another InvestTalk program. We thank you for listening. We encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, Google Play. And be sure to rate and review on iTunes as well. And remember, we can help you better understand your broader financial picture, your investment strategy, and the risk that you are taking in your portfolio by scheduling a portfolio review with me by heading over to investtalk.com. Independent thinking, shared success. This is InvestTalk. Good night.